Now, if you're looking for an easy way to increase your trading profits, there are a few easy steps that can give your bottom line a boost. In fact, these steps should be followed by everyone, really, regardless of your account size or your trading experience. And it's always amazing that when you get your monthly or your year-end broker statement, just how much money you actually spend on trade costs. In the heat of the battle, paying $1 per options contract doesn't really sound like a whole lot of money. But when you add up over thousands of contracts over the year, and it's pretty significant. And that's why you should do your best to negotiate your commission costs on a regular basis. And we'll cover that in a moment. Now, the second area you can focus on is trade execution price. Being picky on your order price can also add up to big savings at the end of the year. Now, these are two areas that are crucial to address if you want to improve your results. So let's take a look how it's done. Now, commissions are a necessary evil in the trading game. We have to pay someone to place our trades each day. In many cases, newer traders research different brokers to find out who has the cheapest rates. Well, the problem kicks in when you just accept the standard rates that are posted on a broker's website. There are so many choices for brokers these days that it's really become a very competitive landscape. So as a result, brokers are willing to bend over backwards in many cases to attract new customers or to keep existing customers happy. So you should contact your broker at least quarterly to negotiate your commission rates. And in many cases, they are willing to do just that. For example, TD Ameritrade charges about $10 plus 75 cents per contract for a standard commission rate for an options trade. There are students in the Option Mastery program that have negotiated this rate down to less than $1 per contract with no ticket charge. Now, this can be a huge savings for your bottom line. So in that example, despite getting rid of the $10 ticket charge, you're saving $1,000 in the first 100 trades alone. That's not too bad considering all it takes is a phone call to your broker to negotiate your rate lower. The second area that can lead to easy savings is in your order executions. Now, options are great products to trade because of the flexibility that they offer and the great liquidity that's found in many stocks and ETFs. Like all other markets, there's a bid price and an ask price when you trade options. The difference between these two prices is known as the bid-ask spread. And oftentimes, traders will just go in and pay the full ask price when buying an option. This is an easy way to get a quick fill on a trade. Well, the problem is that by doing this, you could potentially leave thousands of dollars on the table over time. So let's look at an example. Let's say we're looking to buy a call option on Goldman Sachs to play a move higher in the stock. So we go to our platform and we see that the 152.50 call is trading for $6.20 to $6.75. Now this means the bid price is $6.20 and the ask price is $6.75. So there's a 55-cent difference between these two prices. And that's the bid-ask spread. So if we want to pay full price to buy this call, we would pay $6.75 or $675 per contract. Well, the problem is that we could potentially get filled at a cheaper price. In the Options Mastery program, students are taught to try and place their trades at the mid-price between the bid and the ask. So we just said there was a 55-cent difference between these two prices. So if we try and split the difference, we place our order to buy at $6.50 instead of $6.75. That gives you a 25-cent savings or $25 per options contract. And all we did was change the price of the order. So why don't we do this every single time? Well, the problem with this approach is that by placing the order closer to the mid price, we're not guaranteed an instant fill. We may have to let the order work for a few minutes before getting in the trade. And some traders, they're just not patient enough to do this. But in our opinion, it's well worth the time. And if you're not filled at the mid price, then you can adjust the order up by 5 cents. We would still be saving $20 per contract. So if we add up a $25 savings on each trade over 100 trades, that's $2,500 in savings right there. And that's only one stock. Start to do these figures on a watch list of 20 different stocks, and you can see that there is a significant savings over time. See, sometimes we get so focused on finding the perfect system and the perfect market to trade to try and boost profits that we overlook some of the basics that are sitting right in front of us. A simple phone call to your broker to negotiate your commissions can lead to a $1,000 savings over 100 trades. We talked about that earlier. Being picky on your price that you place your orders at can lead to $2,500 savings over 100 trades. And that's based on trading one contract. That's $3,500 of extra profit that you could add to your trading account. Well, why don't we always do this? Well, most people, they don't feel comfortable negotiating for anything these days. If it could lead to confrontation, most people will just run the other way. Just remember, the broker is there to serve you, not the other way around. On top of that, most people don't have the patience to try and get in and out of trades at good prices. Now, working their orders takes time, and many of us want things as easy as possible. The bottom line is that we're all trading because we want to make money. These are easy ways to help you make more money with very little effort. And I highly encourage you to take advantage of these ideas and enjoy the boost to your bottom line.